Good morning, students. Welcome to the online session of Sri Gokulam Public School, Guruvayur. Children, we were discussing chapter 9 of your business studies. The name of the chapter is Financial Markets. In our previous class, we have discussed what is financial market. We saw that financial market is a market where financial assets are traded. We also saw that financial market can be classified into two: money market and capital market. On the basis of the maturity period of the instrument being traded in this market, they are classified as money market and capital market. In today's class, we will discuss about the different instruments which are traded in the money market. There are 5 instruments which are traded in money market. The first one is call money, second one is treasury bill, third one is commercial bill, fourth one is commercial paper, and the fifth one is certificate of deposit. Let us discuss each of these points in brief. The first instrument of the money market is the call money. Call money is a short-term finance repayable on demand with a maturity period of 1 day to 15 days. They are used for interbank transaction. So my dear children, call money, they are, as you know, short-term finance and they have to be repayable on demand. The maturity period is 1 day to 15 days. So it's a very short span period and they are used for interbank transaction. So that means if one bank is in need of finance, the other bank will fulfill that demand through the call money. Commercial banks have to maintain a minimum cash balance called as cash reserve ratio. You know about that. You have studied about cash reserve ratio in your economics subject. So, the Reserve Bank of India changes the cash reserve ratio from time to time, which in turn affects the amount of funds available to be given as loan, which banks borrow from each other to be able to maintain the CRR. So children, as the rate of CRR changes or it is changed by the Reserve Bank time to time, and when it gets changes, that will affect the amount of fund which is available with the commercial bank to be given as loan. So what they have to do? They can borrow the same to maintain their CRR and they can borrow the same from the call money. Okay, so that option is available for them. The interest rate paid on call money loan is known as the call rate. So as you know, for any type of loan, there is a factor of interest. So interest rate in case of call money is known as call rate. And normally this rate is of highly fluctuable. They are highly fluctuating rate that changes from time to time, that is day to day, and sometimes even from hour to hour that gets fluctuated. A rise in call money rate makes other source of finance cheaper. So because of this interest rate fluctuation and a rise in call money rate makes it or the other source of finance more cheaper. So that is one drawback related to call money. Now the second money market instrument is the treasury bill. A treasury bill is an instrument which is issued by RBI on behalf of the central government to meet its short-term requirement of funds. So who issued the treasury bill? RBI. And on whose behalf it is issued? central government. And do you know what is the maturity period of Treasury bill? It's less than 1 year. Treasury bill are highly liquid, has assured returns and negligible risk of default. So that is a speciality of Treasury bill. That is, it's highly liquid. Highly liquid means highly in the form of cash. And it has the assured returns. Certainly this Treasury bill amount will be repaid. Okay, and it has a negligible risk of default. So assured returns, negligible risk of default and highly skilled, highly liquid, that are the three specialty of Treasury bill. Next, Treasury bills are available for a minimum amount of rupees 25,000 and in multiples thereof. So what is the minimum amount in which Treasury bills are available? It's 25,000 and it goes on in the multiples thereof. Treasury bills are also known as zero coupon bonds since they do not pay any interest. However, they are issued at a price which is lower than their face value. So Treasury bills are issued less than their face value and they are repaid at a par value. The difference between the price at which the Treasury bills are issued and redeemable value is the interest, and their redemption value is the interest receivable on them and is called discount. So whatever difference is there between the issue price and the redeemable value, that is the discount, or we can say the interest receivable on them. So interest receivable is also known as discount. The type of money market instrument is the commercial bill. Commercial bill is a bill of exchange used to finance the working capital requirement of business finance. So you are very much familiar with the bills of exchange. In your +1 accountancy class, we have did the problem related to bills of exchange. So bills of exchange are issued for when the goods are sold on credit. Okay, and the seller draws a bill of exchange and the buyer accepts it. On being accepted, the bill becomes a marketable instrument and is called a trade bill. So once the bill is accepted by the buyer, it becomes a trade bill. Okay, a trade bill can be discounted with the bank if the seller needs fund before the date of maturity. So if the seller are in need of fund and they cannot wait till the maturity period, then they can discount the bill with the bank. When a trade bill is accepted by a commercial bank, it is known as a commercial bill. Okay. What is the speciality of commercial bill? It's a short-term, negotiable and self-liquidating instrument which is used to finance the credit sale of the firm. So children, it is same like we studied in your +1 accountancy. The same concept of bills of exchange is applied over here. So that is what a commercial bill is. The fourth type of money market instrument is the commercial paper. Commercial paper is an instrument which is issued by a large and creditworthy companies. Why they issue this instrument? To raise short-term funds at lower rate of interest than the market rate. So since their need of finance is satisfied through the commercial paper, as it is providing the fund at lower rate of interest than the market rate, so big companies, they go for a commercial paper, issue of commercial paper and raise the fund. The maturity period of commercial paper is 15 days to 1 year. It is an unsecured promissory note, negotiable and transferable by the endorsement and delivery. So it's unsecured means we don't have to keep any security, and negotiable and also it is easily transferable. okay, by mere endorsement or delivery. It is sold at a discount and redeemable at par. So these are the specialty of commercial paper. The purpose of issue of commercial paper is to provide short-term funds for seasonal and working capital requirement, that is bridge financing. So children, this commercial paper, they provide short-term fund for seasonal as well as working capital requirement of the large companies, and that concept is known as bridge financing. Let us discuss the concept of bridge financing through an example. Suppose a company needs long-term finance to buy some machinery. So they are need of the big company, they want to purchase some machineries in order to raise long-term fund in capital market. So they have a choice of raising the fund from the capital market. As you know, purchasing of machinery means a huge amount we have to spend. So they can depend on the capital market for that. Money market, it satisfy only the short term requirement of fund. We cannot borrow huge sum. So long term requirement of fund can be satisfied through the capital market. The company will have to incur flotation cost. So to raise the fund from capital market, there is a cost which is known as flotation cost. And what is this flotation cost? It's the brokerage fees, then cost of advertisement, as well as printing of prospectus, that all involve some cost. So to cover this cost, funds is required, isn't it? So to cover those flotation costs, the companies, they raise fund through the commercial paper. And this type or this process by which the company raise the fund through commercial paper to meet the flotation cost, it is known as bridge financing institutions. Okay, it's a very important concept, students. Next one, the fifth instrument of money market is the certificate of deposit. This is unsecured, negotiable and short-term instruments in bearer form, issued by the commercial banks and development financial institutions. So what is the characteristic feature of certificate of deposit? It's an unsecured, we don't have to keep any security, it's negotiable, and it's a short-term instrument in a bearer form. Bearer form means any person can handle that instrument. Issued, and who issue this? It's issued by a commercial bank or the development financial institutions. They can be issued to whom we can issue this? We can issue the certificate of deposit to the individuals, corporations and companies during period of tight liquidity, when the deposit growth of bank is slow but the demand for credit is high. When the demand is high but supply is low, at that situation we can issue the individuals and corporation and companies, they depend on the certificate of deposits to satisfy the need of finance. They help to mobilize a large amount of money for short periods. So the certificate of deposit, they can mobilize a huge amount for the short period. So this is about certificate of deposits. So children, now it's time to conclude today's session. In today's session, we discuss about the 5 different types of money market instruments. It's a very important question. So do read the textbook covering these points. Attend the test paper attached. Meet you in the next session with a new topic. Till then, goodbye. See you.